Welcome to The Explainer. Today, I'm stepping into the role of your senior investment analyst to really demystify the entire initial public offering machinery for you, our incoming portfolio manager. Look, you're entering a world where literally billions of dollars change hands in the blink of an eye. And to succeed here, you need to understand exactly what's happening beneath the surface of the financial markets.
Now, you've definitely seen the headlines, right? Media hype surrounds us every single day. You'll constantly hear these breathless quotes about oversubscribed shares or massive first-day price jumps. Individual investors absolutely love stories about early backers getting unimaginably wealthy overnight, which is why so many people rush to buy shares in a brand new IPO. But our job as professionals, we have to look completely past all that noise. We've got to remember that stocks represent actual ownership in real, living businesses, not just a lottery ticket.
Okay, here's our roadmap for analyzing all these IPO mechanics today. First, we'll cover the hype versus reality, then why companies go public, followed by the underwriters and valuation, the listing day dynamics, evaluating core business fundamentals, and finally, the post-IPO reality.
Let's dive right in with Section 1, the hype versus reality, deconstructing the IPO.
So, what exactly is it? At its core, an IPO is simply the exact moment a private entity unlocks its vault. It's the very first time everyday public investors are allowed to buy an ownership stake. And when that happens, you're seeing a massive transfer of capital and risk directly into the public domain.
Think about the sheer scale of that transition. Before the IPO, company ownership is this closed, highly exclusive ecosystem. We're talking founders, venture capital firms, angel investors, maybe a handful of early employees. But after the IPO, it flips to completely open, public ownership. Literally anyone, anywhere with a standard brokerage account can suddenly become a shareholder.
Let's track a typical growth cycle to see how we get there. Say, in year one, a tech startup is funded entirely by the founder's personal savings, hustling in a garage, right? By year three, to actually build out the product, they bring in private venture capital. But fast forward to year 10, and the company is exploded. Revenue is way up, the customer base is massive, and honestly, private funding just isn't enough anymore to sustain their ambitious global expansion. They need a completely different vehicle to keep growing.
Which brings us to Section 2, why companies go public. The need for capital and liquidity.
An IPO is essentially the ultimate financial toolkit. First and foremost, it solves the company's desperate need for expansion capital. By selling shares to the public, a business can raise billions of dollars to build factories or fund massive research projects, all without having to pay back expensive, crippling bank loans. But just as crucially, it provides liquidity. It's the exit strategy that allows early venture capitalists and founders to finally cash out their illiquid shares. On top of that, it boosts the company's visibility and lets them use their newly public stock as literal currency to acquire other businesses down the road.
Moving on to Section 3, the underwriters and valuation, the machinery at work.
The actual journey to an IPO is a pretty grueling six-step process behind the scenes. First, the company goes through months of exhausting financial audits. Then, they pick their investment banks, the underwriters, who act as the critical intermediaries between the company and the market. These underwriters help structure the whole deal and take the executives on what's called a roadshow. It's basically a massive sales tour where management pitches their growth plans directly to big institutional investors to gauge interest. And following that roadshow, the underwriters finalize the pricing and allocate those initial shares.
Right in the middle of all that is the valuation phase. What is the company actually worth? This is where the underwriters really earn their keep, because they don't just guess. They built incredibly complex discounted cash flow models. They run comparable company analyses against existing public stocks. They even stress test macroeconomic conditions. They do all of these highly specific steps to arrive at a definitive enterprise value before a single share is ever priced for the public. And the basic math they use at the end is surprisingly straightforward. If that rigorous analysis says the company is worth $10 billion and the company decides to issue 1 billion shares, well, you just divide the two. Each share gets priced at an initial value of $10. But it is an incredibly delicate balancing act. They have to find a price that is attractive enough to pull in investors, but still high enough to raise the capital the company needs.
All right, Section 4, the listing day dynamics. Supply meets demand.
So that carefully calculated IPO price we just talked about, that's really just the starting line. Once the opening bell actually rings, the underwriters step back. From that second on, pure unbridled market supply and demand takes absolute control.
If retail and institutional investors are overwhelmingly pumped about the stock, demand crushes supply, and the price rockets upward. But if they're disappointed, it can instantly sink below that initial benchmark.
Now here's something kind of counterintuitive. Say a stock leaps 50% on day one. Amateurs celebrate that, right? But we analysts view it very differently. If a stock jumps that dramatically, it usually means the underwriters actually priced it too low. The company sold those shares to early investors at, say, $10 when the broader market was clearly willing to pay $15. So the company basically failed to capture all that extra capital for its own growth. They essentially left money on the table.
Let's look at Section 5, Evaluating Core Business Fundamentals.
As a portfolio manager, whenever a new listing crosses your desk, you have to relentlessly strip away the media hype and audit the actual fundamentals. You've got to look at their profit margins to gauge operational efficiency. You need to scrutinize their customer acquisition costs against their growth rates and strictly evaluate their moat against competitors. Remember, you are buying a piece of a business. You have to act like a true owner rather than just blindly following sensational headlines.
Listen, a great consumer product does not automatically equal a great stock. Individual investors make this mistake all the time, choosing to buy shares just because they're obsessed with a new phone or a cool new app. But if the valuation doesn't make mathematical sense based on a realistic runway for profit, it's just overpriced hype. Smart investors buy for future cash flow, not brand popularity. To be successful, you absolutely have to divorce your emotions from consumer trends.
And finally, Section 6, the post-IPO reality, the burdens of being public.
You see, that massive initial capital influx comes at a really heavy cost. Going public means sudden, total transparency. The company now faces mandatory quarterly and annual financial disclosures. They're hit with massive regulatory compliance fees, and they deal with relentless scrutiny from people exactly like us. Every single highly visible dip in the stock price creates intense pressure on the executives. It creates this constant, exhausting tension where they have to manage short-term quarterly expectations while still trying to execute their long-term strategy.
But zooming out for a second, this highly regulated, sometimes really messy IPO process is the absolute engine of global capital formation. It connects companies that desperately need funds to build factories, to develop life-changing products, to hire thousands of employees, directly with investors who are actively seeking opportunities to grow their wealth. Without this incredibly efficient allocation of capital, modern economic expansion would just stall entirely.
I want to leave you with a final provocative thought as you begin building your portfolios. The next time you see a massive headline about a hot new initial public offering, ask yourself, when you buy an IPO, are you just chasing a flashing ticker symbol on a screen, hoping you get lucky? Or are you effectively evaluating the core business fundamentals to claim real, lasting ownership in the broader economy? Always remember exactly what you're buying when you step into the public markets.